Everyone thinks getting approved for a mortgage is simple. Have a job, make decent money, don't miss payments. That's the story we're told. But here's the mystery. Why do two people with the same income, the same house price, and the same down payment get completely different outcomes? One approved instantly, the other rejected without explanation. Why do lenders sometimes approve loans that later explode into crisis and deny loans that look perfectly safe? And why does the system seem less about you and more about something invisible, mathematical, and deeply historical? Today's video isn't just about credit scores or paperwork. It's about how lenders actually think, what they fear, what they optimize for, and how a centuries-old risk system still decides who gets access to the most important financial asset of their life. Because when you apply for a mortgage, you're not being judged as a person. You're being translated into a risk profile. And the rules of that translation were written long before you ever filled out an application. The origins. Why mortgages were never about trust. To understand what lenders look for today, we have to start with a truth most people don't realize. Mortgage lending was never built on trust. It was built on fear. In early banking systems, long before credit scores or income verification, lending money was deeply personal. A lender knew the borrower, their family, their land, their reputation. But as cities grew and money became abstract, personal trust collapsed. Banks faced a brutal question. How do you lend large sums of money to strangers and still survive when some of them inevitably fail? The answer was collateral: land, property, houses. The mortgage, literally death pledge, meant that if you failed, the property died to you and returned to the lender. But collateral alone wasn't enough. Banks needed a way to predict failure before it happened. That's when the system shifted from character to patterns. Instead of asking, "Are you honest? Are you hardworking?" lenders began asking, "How likely are you to default? How does your behavior compare to millions of others?" And that mindset, ESCO over morality, is still the foundation of mortgage approval today. The rise. How risk models replaced human judgment. Fast forward to the 20th century. Homeownership became a political and economic goal. Governments wanted stability. Banks wanted scale. Families wanted certainty. But mass lending created a new danger. Human judgment doesn't scale, so lenders turned to models. Credit bureaus emerged. Statistical scoring systems were born. Probability replaced intuition. This is where the modern mortgage framework took shape. Lenders began evaluating 5 core pillars, often called the 5 C's of credit. Capacity. Can you afford the payment? Capital. How much skin do you have in the game? Collateral. What backs the loan? Character. Your past behavior with debt conditions. The broader economic environment. But here's the twist. Over time, character became a number. Your payment history? Utilization? Age of accounts collapsed into a score designed to predict one thing only. Will this loan perform according to expectations? Not whether it's fair, not whether it helps you build a life, only whether it fits the model. What lenders actually look for: the hidden mechanics. Let's break the illusion. When you apply for a mortgage, lenders are not asking, "Can this person buy a house?" They're asking, "How much uncertainty does this loan introduce into our balance sheet?" Here's how they answer that, piece by piece. 1. Income. Stability over size. Contrary to popular belief, lenders don't care if you make a lot of money. They care if your income is predictable, documented, likely to continue. A borrower making $70,000 for 5 straight years often looks safer than someone making $150,000 with volatile bonuses or self-employment income. Why? Because models hate uncertainty. That's why lenders, average variable income over years, discount freelance or cash-heavy work, demand long employment histories. Not because they doubt you, but because their risk formulas do. 2. Debt-to-income ratio, the silent gatekeeper. This is where most approvals live or die. Your debt-to-income ratio, DTI, answers one question: how much of your future income is already spoken for? Even with a high credit score, a high DTI signals fragility. Why? Because history shows people default not when they want to, but when they're stretched too thin. DTI isn't about today. It's about what happens when something breaks. 3. Credit history. Behavior matters more than score. Your credit score is just the headline. What lenders really analyze is the story underneath. Late payments, patterns of borrowing, recovery after mistakes. Length and consistency of credit use, a single missed payment 5 years ago. Often irrelevant. Repeated almost failures? Red flag. They're asking, when pressure increases, does this borrower adapt or collapse? 4. Down payment. Psychology disguised as math. Everyone thinks down payments are about protection. But they're also about behavioral risk. Data shows borrowers with more equity default less, fight harder to keep the home, view the house as an asset, not an option. So a down payment isn't just capital, it's a signal. How painful would walking away be? 5. The property itself, the loan's real customer. Here's the uncomfortable truth. The house matters almost as much as you do, lenders ask. Is this property marketable? How stable is the neighborhood? Would this asset retain value in a downturn? Because in a worst-case scenario, the property becomes the repayment plan. You are the first line of defense. The house is the last, the breaking point. When models failed, then came the moment that exposed everything. The 2008 financial crisis. Lenders had become so confident in models that they stopped questioning assumptions. Risk was sliced, bundled, insured, and sold. Approval standards collapsed not because lenders stopped caring, but because they believed risk had been neutralized. It hadn't. When defaults spiked, the truth emerged. Income stability mattered more than expected. Property values weren't guaranteed. Human behavior under stress broke models. The same tools designed to reduce risk had amplified it. After the crash, fear returned. Standards tightened. Documentation exploded. Automation increased. Lenders shifted from flexibility to defensibility. Why? Because now approvals weren't just financial decisions. They were legal liabilities. Every loan had to survive. Audits, repurchase demands, regulatory scrutiny. So lenders began asking, can we defend this loan if everything goes wrong? That mindset still dominates today. Technology promised fairness. Algorithms promised objectivity. But the core problem remains. Models are built on past behavior, not future potential. This creates repeating patterns. New workers struggle. Non-traditional income is punished. Economic shocks hit the same groups hardest. The system doesn't ask, can you grow into this responsibility? It asks, have people like you survived it before? And that's the quiet bias built into modern mortgage lending. Today we see familiar signals: rising interest rates, household debt, climbing tighter credit conditions. Lenders are once again prioritizing liquidity reserves, conservative assumptions, not because they're cruel, but because they remember what happens when models lie. The cycle continues. Final takeaways. So what should you take from all this? Takeaway number 1. Lenders don't approve people, they approve risk profiles. Takeaway number 2. Stability often matters more than income, intelligence, or effort. Takeaway number 3. The mortgage system rewards predictability, not potential. The warning: 58 minutes and 0 seconds to 59 minutes and 30 seconds. The danger isn't rejection. The danger is misunderstanding the game and assuming fairness where there is only probability. If you don't know what lenders are optimizing for, you'll keep trying to prove the wrong things. If this video changed how you see mortgage approvals, like it tells the algorithm this kind of deep financial education matters. Subscribe if you want more breakdowns of the hidden systems that shape money, debt, and power. And comment below, what part of the mortgage process surprised you the most? Because the more you understand the system, the less invisible it becomes.